All right, what up, everybody? It is Jeremy with Escape Velocity Trading coming at you for another market bias update report for Sunday, January 12th. It is about 4 p.m. on Sunday, and we are diving right in to review last week's trading, and then we will get into some charts. So, starting off, this is going to be a reminder of exactly what not to do. And I'm honestly a little embarrassed that I even made this mistake as a professional trader of 8 years. I'm still scratching my head around what possessed me to do this, but I broke my risk rules last week and paid for it. So you can see here I had three different trades, 2250, 14,200, and then a loss of 32,725. Ended up losing 16,275 overall for the week. And let's look at the chart real quick to see what I was seeing and why I broke my rules, and use this as a cautionary tale because I have built my account diligently over the last 8 years to the point where I can take a loss like this and brush it off and move on with my day-to-day trading, and it is okay. But a lot of people, if they took a loss like this, it would blow their account up and completely annihilate their ability to continue to trade. So let's go in and look real quick just to show this. And we're going to spend a touch of time here because this is a really, really important lesson to have. So going out to the chart, you guys know if you follow my channel at all that I trade a lot of futures on Bitcoin. And the trade that I had placed, I did two of them. The one that I gained 14,200, I played the breakout of this little high base pattern. So we had 3 or 4 days of momentum coming off the lows, off of a known support zone. Then we dojied for 2 days. And when we broke out above that level, that was considered a breakout. We had high volume on that candle breaking out of the consolidation that we had had for the last couple of weeks of volume. So we had volume confirmation, a pattern, and a breakout. I took that trade, ended up locking in over $14,000 worth of gains. But at the top end of this channel on the intraday chart, I saw another trigger and it looked to me like it was going to break out once again. And because this daily candle closed right up at the absolute highs, was pressing into resistance, and had that breakout confirmation on volume, I was expecting this to go to all-time highs, if not past all-time highs. And I decided to take a trade, not only risking what I had just locked in, but risking up to about my typical allowance for a week's worth of trading. If you follow my trading account, you'll know that overall, my gains and losses per week range from anywhere from a few $1,000s up to 15 to 16 is kind of the upper threshold for me in terms of my risk allowance. And then sometimes I will gain up to 35 or even 40. But this one right here, I ended up taking another trade after exiting and taking my initial profit at this resistance line. Took that, and here is where I messed up. I should have had a very tight stop loss on that, but because I saw this candle close at the high with the confirmation on the volume, I decided to take a larger risk profile. Normally, my risk profile is about 2% of my overall account. This time I did 4, and that was my big mistake. And I got smoked on the next candle here. Just intense selling coming in all day long with a much looser stop back down below the consolidation of this high base here. And this actually occurred on a day that I was not in front of the market at all. I just set automated orders and I went snowboarding for the day. So I came back to see a massive wipeout there. And this is just a big reminder to you guys, you have risk rules for a reason. And it doesn't really matter if your account can handle that extra risk or not, because no matter how good the setup looks, you never know if this setup is going to be the one that doesn't go according to your analysis. And we have those risk rules for a reason to protect us. So anyways, long story short, ended up taking a loss of 16,275 today, wiping out what would have been an otherwise great trading week. And now I have to go lick my wounds and go back to the drawing board to work on building that back up. So going out to look at our actual charts, overall in the market, we are sitting at a very important support and resistance line right here on the S&P. And this to me looks like a head and shoulders pattern. So we have the left shoulder here, the head, the right shoulder. And if this breaks down and closes below, that is technically a topping pattern, which means more selling pressure might be in store for us. If we do close and break below that, my target would be back down to somewhere between the 55 and 60 range on the S&P, correlating also to the peaks and resistance over here from the last 6 months. And then to get bullish on this chart again, really, we need to get back above 600. If we can get back above 600 and close above there, that would invalidate the head and shoulder pattern. But for now, pressure is to the downside, and we have to expect more downside pressure to come. Going out to the Nasdaq, very similar, but a little less clean of a pattern, but we can kind of draw out one right here. Little bit sloppy, but still have kind of the left shoulder, head, right shoulder. Again, a break below this would signal more selling, coming back down to about 480. Going out to the Dow Jones, we are sitting at support on the Dow Jones. We have been overextended to the downside on our RSI. Our MACD is firmly in bearish territory and temporarily crossed back above, signaling potentially a bottom, but it looks like it is going to cross back down again. So right now, this is a stay away. To be bullish again, we really have to get back up above the 50-period moving average. So this is going to take some time and is not on the radar currently. And then going out to the Dow Jones, it actually has been leading the charge to the downside. And we can see on Friday, we actually did close below this very important support and resistance line, confirming a head and shoulders pattern to the downside. So expecting price drop down to about 410. Now, going out to IBIT, the Bitcoin ETF I track, it is sitting on its 50-period moving average. Hasn't done anything wrong yet, but this pattern all of a sudden looks much less interesting. And here, looking at this chart instead of the actual Bitcoin spot chart, we can see the diagonal support zone that we had previously had here. And if we extend that out, where I took profit on my initial position was underneath that diagonal support zone that had now become and was confirmed as resistance. So to get into a bullish stance again, we are going to have to clear that level. On the ETF, that is going to be about 58 to 60, depending on if you want to clear the wick from here or not. But this now needs some time because the patterns have now officially been blown up. Going out to Ethereum, very similar thing, except we are below the 50-period moving average. And this is actually a double top pattern right there. Came back up. This is kind of a kiss of death off of the resistance support zone. And now we've broken down below the 50. So this is a stay away for now. Going out to XLB. Low base currently. If we do get back above the 20-period moving average, we will still need a little bit of time for the moving averages to clear themselves out, for the 9 to curl and get back above that zone. But initial initial price levels to be keeping an eye on would be somewhere around $86 to the top side. If we put this out to a weekly chart, you can see we are actually breaking the 200-period moving average, and it looks to me like this wants to go lower. We are overextended on the RSI, so I wouldn't be surprised to see a little bit of a reprieve bounce and then a break below the 200-period moving average moving forward in the next week or two. Going out to XLY, our consumer discretionary, we again are testing that 50-period moving average, which really needs to hold if we are going to hold on to any semblance of bullish conditions here. But right now, I see this as neutral, threatening to break down into bearish territory. If this breaks down below 219, that will officially go into bearish territory. Going out to XLK, again, pressure rolling over. You guys are probably seeing a theme here, and this theme has not been seen in the market for a while. We've been bullish across the board for most of the last year, if not year and a half, and we are now finally starting to actually see patterns rolling over to the downside. So XLK is no different. We had kind of a consolidation pattern here, stock in a box moving sideways between the support zone around 225 and the resistance zone around 242. We are breaking down on that, and continuation to the downside would probably lead us down to about 220. Going out to XLE, a little bit of strength on the reprieve here, but it just got absolutely killed over the last month or two. And I am seeing this probably more so as a reprieve rally within bearish conditions. So watching for this to roll over. If we get down below 86.40, let's call that, that would be a resumption to the downside. Going out to XLU, a little bit of a low base here after a breakdown. This could technically be either a double top or potentially a triple top here, depending on how you want to look at that, which is a longer term topping pattern. And if we toss this out to a weekly chart, this is confirmed as a double top, breaking down below our little support zone here at around 76.50. And the next price target to the downside would probably be around 72.30. Jumping out to consumer staples. Consumer staples just got absolutely killed over the last couple of weeks. It does not look like it has any support down below it, and we have actually just set in a new 6-month low on this price. When momentum starts, it tends to get a life of its own, so I would not get in the way of this trying to play a bounce. Instead, be looking for some kind of a reprieve rally and then be shorting again on the downside. Going out to communication sector, again, almost identical patterns, a little bit of a head and shoulder here, breaking down on Friday, and any continuation to the downside has to be looked at with a target of probably 91 for T1 and then a target 2 of down around 88.50. Going out to industrials, we have a little bit of support from the 200 period moving average below us. Our MACD is firmly in bearish territory. Our RSI has been overextended to the downside and did signal a little bit of reprieve might be coming, but I am not sure I am buying that. I am looking at this on the weekly and thinking that at least a test of the 50 period moving average at 128 is in the cards, if not below. So we need to be keeping an eye on that, and especially if we end up breaking this diagonal support, which a test of the 50 would technically break that diagonal support line as well and signal potentially more downward pressure to come. Going out to XLF, this one actually is one of my favorite looking ones for potentially shorting right now. I love the length of the consolidation pattern here. I love the decreasing and crossing over moving averages. If we toss this out to a weekly chart just to see where we are in terms of support, there is really no support until we get down to 45.70, but actual support is going to be bound at about 44. So XLF is my favorite shorting opportunity so far this week. Going out to healthcare, this one potentially could be bottoming there on the daily chart. Let's see if we have any support here on the weekly, and we do. We are testing the weekly 200 here. This one probably needs a little bit of time. I would not be opposed to this coming back down and retesting the lows down around 135 and change, and then waiting for a little bit of time, a little bit of consolidation, hopefully with a breakout to the upside. But if we get that consolidation and break the 200 period moving average to the downside, that will be a short opportunity as well. Going out to XLRE, this is our real estate sector ETF. On the weekly chart, this has broken down hard with momentum. We are firmly in bearish territory. If we toss this to a daily chart, we had a low base here with a breakdown. This is also a beautiful shorting opportunity. Going out to gold. Gold had poked its head up on Friday and broke out of our little wedge pattern here. I would expect a little bit more strength to come into the gold market and silver market if the rest of the market actually breaks down. But I already have full exposure in this area, so I am not looking to add. I will probably be selling covered calls on any bounces or any pushes to the top side here, because I think we are going to be more in consolidation than any kind of trend with gold. Going out to silver, remove these drawings. And silver, I think we need to look at on a weekly chart here. So on the weekly chart, we are trapped between the 20 and the 50 SMAs. We have a diagonal resistance line overhead. If we break below that 50 period moving average, I would expect us to come back down and test this 24 zone, which was the major support and resistance zone over the last 3 years. Finally, going out to the US dollar, dropping this back to a daily chart, you can see we are still in a very strong uptrend for the US dollar. And going back to the weekly, you can see we broke out of a very important resistance zone. And to me, this looks like it wants to come back up and test highs around 114. Finally, last but not least, let's go out, check out our heat map. This is a 1 week performance showing how money has rotated throughout the market over the past week. You can see tech lagging, a little bit of consumer cyclical strength holding in, but not able to actually support the rest of the market. And then a little bit of strength and energy coming off of that reprieve rally. But overall, I am seeing more red than green. And this tells me that I am wanting to lean towards shorting instead of going long in equities. Finally, let's go out to Forex Factory and check out the economic data coming our way. We have a busy week coming out. Monday and Friday, there isn't any data that we need to concern ourselves with, but Tuesday, Wednesday, and Thursday, we have an onslaught of data that is going to be very important to the market. These are all inflationary readings that the Federal Reserve uses to decide if and when they are going to continue their rate cuts. It is widely expected that they are going to go into a pause and probably not make another cut for at least the first quarter of 2025, which the market is not going to like. But it is going to be important to be aware of these reports coming out at 5:30 a.m. before market open. That is Pacific Standard Time. And just make sure that you are controlling your risk going into those events. With that, guys, as always, trade safe. Let me know if you have any questions. Hit me up in the comments, like and share, and I will catch you next week.